Okay, good afternoon again, guys. And again, we are here in our discussion for bonds payable. Okay, again, this is your Prof. Zeus, and I'd like to welcome you to another video for accounting and financial reporting. Okay, so what we're going to do is now we will look at the difference or what will happen if it's the reverse. Okay, meaning this one is 10 and this one is 6. So now it's the reverse. It is the nominal rate that is bigger than the effective interest rate. Now let us see what will happen to the issue price of the bond. Okay? Let us go back to the first one, which is every December 31st. Okay, again, let's do the timeline. Let us do the timeline. So every December 31st, 1, 2, 3, 4, and 5. Okay? So every December 31st, the bond issuer will have to pay the nominal interest to the bondholder or the bond investor. And at the end of the 5 years, okay, on the 5th year, he will have to pay the 1 million principal. So this is now your principal. Now what about the periodic payment of interest? So he will have to pay 10% of 1 million, that is 100,000. So 100,000 every December 31st. Okay, so this is 100K. Okay, so again, your timeline now, you can see that you have 100,000 every December 31st. And at the end of the 5th year, which is the maturity of the obligation, we have the 1 million, which is the principal amount. Okay? So we have changed, okay? We have changed that into the nominal and the effective. The nominal now is 10%, which is higher than the effective, which is 6%. So the issue now is how much will the investor how much will the investor pay for this type of bond? Okay? So again, we're going to find for the present value of the principal and the present value of the interest. Okay, so the principal now is again 1 million pesos, and then the interest now is 100,000. Again here, since this is just one time, we will use the present value of 1, and here we have to use the present value of annuity. Okay, so let us now compute for the present value factors. So that's 1.06. 1, 2, 3, 4, 5. So that's 74. 0.74. 72. And then minus 1 divided by 0.06. So this is times 4.2123. Okay, let me just check it again. 7472. Okay, so let's now compute. So this is 747,200, and this one is 421,230. 4.2123 plus 747,200. Okay, this is 1,168,430. So this is now the issue price of the bond. Now, if you would notice now, the issue price of the bond is higher than the principal amount of the bond, because the principal amount of the bond is 1 million pesos. Or there's a difference of 168,430, and this is what we call a premium. That is now what we call a premium. Now, just like what we did for discount or for bond discount, we are going to allocate, or we are going to amortize this premium on bonds payable over the term of the obligation, which is 5 years, using the effective interest rate. Okay? So, if you are the investor, would you be willing to pay 1.1 million for a 1 million bond? Because at the end of the term of the bond, the bond issuer is obliged to pay you only 1 million. He will not return the 1.1 million to you. What he will return is only the 1 million. So the question is, you as the bond holder or the bond investor, are you willing to pay more than 1 million pesos? You are losing actually 168,430. So question again, are you willing to pay more than what you will receive in the future? What do you think, guys? Is the investor on the losing end or no? Now, remember my discussion earlier when we compare this nominal and the effective. Okay? So therefore, if you look at the interest, you as the investor, you're getting 100,000, right? But the other issuer of bonds is only offering 60,000 pesos interest every month. So in effect, you are actually what? On a positive or advantageous position by 40,000. So 40,000 times 5, that's 200,000. You gained actually 200,000 more than what others are actually realizing as income, because you invested in this type of bond. So therefore, your bond issuer is now asking for a premium because it's giving you more than the other players in the market. So in effect, 200,000 minus 168, you still have a gain of about 20. So that's 200,000 minus 168, 430. You still have a gain of 21,000. Okay, rather than investing in other issuers of bonds, if you invest in these bonds, you will still have an additional income of 31,570. Not bad, right? Okay, so next step is we're going to do the amortization table. Okay, again, what is the rationale between in amortizing this one? Because at maturity, the bond issuer will be paying you only the principal amount of the obligation, which is 1 million. He is not obliged to return to you the 1.1 million that you gave him, no? Because remember, it's according to your contract, he will return the principal sometime in the future. You cannot demand 1.1. Even if you take him to court, he will win, because based on your documents, he's obliged to pay or return to you only the 1 million pesos. Okay? So, how are we going to record this transaction? Okay? So, let's erase this one. Okay. So, therefore, he received cash. So, therefore, cash for 1,168,430. And then you have bonds payable amount for the principal of 1 million pesos. And then you have the premium. Premium on bonds payable for the 168,430. Okay? So this is the entry upon issuance of the bond. Now, what will happen is that every December 31, the company will pay 100,000 amount of interest, and of course, we are going to amortize this 168,000 for a period of 5 years. Okay? So let us now prepare the amortization table. Okay, again, let's have the date. Okay. And then we have January 1, which is the date of the transaction. So the carrying value is 1,168,430. 430. Now, 1 Again, the objective is for us to bring this 1.1 million down to 1 million at the end of the 5th year. Okay? Because this is the principal amount of the obligation. Okay? So therefore, on December 31st, again, the company will pay 100,000. Okay? But the interest expense is, interest expense is 0.06 times 1168 for 30. So this is 70,000. 106. Okay? So that's 100,000 minus 70,106. That would be 29,894. Again, if you look at this one, the carrying value is higher than the principal amount. So what we're going to do is we are going to deduct the amortization. Okay? So minus 1168 430. So this becomes 1,138,536. Okay? And then again on December 31, 100,000 in terms of interest payment, that is the nominal. So therefore times 0.06, 68,312. So plus 100,000. So this will be 31,688. And again, objective is to decrease this, bring this down to 1 million. So minus 1,138,536. So 1,106,848. Okay? So the carrying value of the obligation at the end of the first year is 1.1 million, 1.138,536 if that will be the question. On the second year, that will be 1,106,848. Okay? Let's now go to the third year. So this is 100,000 again. And times 0.06. So this is 66,411. So therefore, 100,000 less 66,411. So this is 23,589 minus 1,109,848. So this is 1,073,259. Okay? On the fourth year now, this is 100,000 again times 0.06. So this is 64,396. So 100,000 minus 64,396. This is 35,604. So 1,073,259 minus 35,604. So this is 1,037,655. Again, we will have a difference on the last year because of the rounding off, okay, because of the decimal point. So therefore, what we need to deduct is 37,000. We'll just adjust it on the last year, 655. So this will become 1 million. So therefore, this is 100,000. So 100,000 minus 27,655. So this becomes 62,345. Okay? So we have here now the amortization table for this problem. Okay? So if you would see, the amortization is being deducted from the carrying value of the obligation at the date of transaction because again, the objective is for us to bring this down to 1 million, which is the principal amount. Now, every December 31st, what the bond issuer will do is to pay the interest and amortize the premium. Okay? So therefore, payment of interest is liable to pay 100,000. So debit interest expense for 100,000 and credit cash for 100,000. Right? Now, this time, if you look at the amortization, remember that the premium has a normal credit balance. It's added to the liability. So in order for us to take this out from the books of accounts, we have to debit the premium on bonds payable. So let's do that. So the amortization entry is what? To debit the premium on notes payable. Notes payable for 29,894 and credit your interest expense for 29,894. So if you look at the effect, guys, if you would notice, the interest is debited for 100,000 but credited for the amortization for the 29,894. So therefore, if the question in the examination is for you to find the interest expense as of December 31st, your answer would be this one, 70,106. Okay? Now, if the question would be the carrying value of the obligation at the end of each year, this will be your answers. December 31, 2019, 20, 21, 22, 23. Okay? So at the end, so every year, this one will be recorded, 100,000 payment of interest, and of course, this amortization. Okay? So instead of 29, the following year, that's going to be 31,688, 23,589, and down. Okay? So therefore, at the end of the obligation, meaning at the maturity date of the obligation, the bond holder, the bond issuer, will have to pay the principal amount of the obligation, right? So therefore, the entry would only be debit bonds payable for 1 million and credit cash for 1 million. After, of course, paying the remaining 100,000 interest and the amortization of 27,655. Because once this is recorded and posted in the books, the premium account will be equal to 0. So therefore, you can just pay the obligation by debiting bonds payable and crediting cash. Okay? So again, if you notice the difference between a discount and a premium, the discount you have to add the additional interest. Okay? Which is the amortization of the discount. But in terms of the premium, this is what? This is a deduction in terms of interest expense. Okay, why? Because in effect, the holder of the bond is what? The issuer of the bond is what? Recovering. No, he's able to recover a portion of the interest that he paid to the bond holder. Okay, so again, this is bonds. Okay, using the or under the premium. Okay, meaning the nominal interest is higher than the effective interest rate. Okay? Now, thank you very much again for watching my video, and I hope you learned something from me for this session. Okay? Now, I'll be seeing you again in my next video. Please don't forget to subscribe and hit the bell button so you can be notified whenever I upload new videos. Again, if you want to request a topic in financial accounting for me to discuss, just comment, and then I'll try my best to discuss your requested topic. Okay, thank you very much, guys. And again, this is your Prof. Sus. See you again in my next video. Thank you, bye.